Hey, this is Tim Turner, Torrid Technologies, and today we're just doing a live call, open questions. Had a couple people send in some questions, and hopefully we'll have some from those that are logged in. So if you have any questions, please put them into the question box so that I can address them. If you don't have any questions, this is going to be quite a short little meeting here. Did have a couple of questions come in by email from people who couldn't be on the call. So let me pull up our software. Here's the RetirementView software, which should look familiar to most of you. I'm looking at the list, and most everyone on here is using it already. So let me just pull up a sample file, see if I can find something in here. Let me sort it by name. I'll just pull up the Sally sample thing. If I can find it. Sam and Sally sample. Okay. Let's pull this up. All right, so here we have a basic plan. One of the questions that came in was about taxes, and I've gone over it many, many times, but we don't have every customer on every call, so that means I'll continue to go over it, which is not a problem. Okay, the number one question we have is for the retirement goal in today's dollars. Is that after taxes or before taxes? And I think we should probably change the little in today's dollars. We should probably go ahead and put on there after taxes. Should probably add that in there. So this is $60,000 spendable cash. The program will figure out how to generate that from the different accounts based on the account types and the different taxation methods. However, I think the reason why we didn't do that is because you could go into the taxes and in the tax rate set everything to 0. And if you did that, then the retirement income goal would be a gross number because no taxes would be being taken out. So that's why we didn't force it to that. And over the years, we've had some people say, I just want to do a gross analysis, or do a gross analysis but put taxes on special expenses because they were a CPA. So that's one of the first things about taxes. Second thing is how the taxes are used. We asked for the federal marginal and state rate. The purpose is simply to get something in here that's conservative. You don't pay federal taxes on your state taxes, so it's not quite the sum of the two. So our program, when you touch this, it'll make a little mini calculation there. However, some people don't realize that you can go in here and enter an effective rate. So let's say I'm a CPA and I calculated their total taxes paid into their gross income and determine their tax rate is 18.2, then I can just click on the effective rate and make it 18.2. And when I do that, then the federal marginal and state are simply for purposes of printing it onto the printout. They would not be used anywhere other than on the printout. The number that's getting used is this 18.2. Okay, so just want to give you an overview on the taxes and how to set them. The next question was on how are the taxes factored into the program. So first of all, if we go into Social Security and put in a benefit of $25,000, and then I roll over here, it says $33,000. That's probably because we have something for Sally. Okay, we got 25 for Sam and 10,000 for Sally, but it doesn't add up to 35. It's slightly less than that because of the taxes that are taken out. And it does implement the IRS algorithm for that to determine how much of it is 0% taxable, how much is 50% taxable, and how much is 85% taxable. So keep that in mind. Pensions, same thing. We just net the taxes out. So let's see. does Sally have a pension? No. Oh, here we go. 9,963 if you look in the yellow box, so it's less than the 12,000. So that's netting out the taxes. So the program's doing that on a sort of income stream basis. Then we come to the investments. If we have tax-free investments, in this case we don't have any tax-free investments, but let's say they had, you know, 200,000 in tax-free investments. And if we got to the point where we applied the Social Security and the pension, and all they needed was maybe another 25,000 of income, it would pull it out of tax-free, and it would not remove any taxes. It wouldn't take out additional taxes. It'd say, aha, we're taking this out of tax-free. Now, taxable investments, I wish that we could find a way to be a little more precise. If you buy and hold your stocks, your mutual funds, and what have you, you could get a long-term capital gain rate. But in the program, we don't have room to put in buy and sell dates, and we don't want you to have to figure that out. We just want to tap these buckets as needed. And in which case, the taxable investments, we're netting the taxes out of the return. So if we have an 18.2% tax rate and a 5% return, then the program is just giving it a lower return. It'll be approximately, what is it, 81.5% of 5%, whatever that math turns out to be, would be the return. And that kind of overstates the taxes, but that would be the conservative way of doing it, kind of overstating the taxes rather than underestimating them. So that's how we do that. If you really don't like that, you could, again, do your own tax estimates and zero out the tax rates. That's one option. Qualified money. This is a common question. When we dip into the qualified money, are we accounting for taxes? Yes. If we go march through all these different income sources, Social Security, pensions, cash infusions, maybe we've hit the tax-free, we've hit the taxable, we finally get to the qualified money. Let's say we need $10,000 out of there. It's going to take out more than $10,000 to cover the 18.2% tax rate that we've set as the effective rate over here on other assumptions, right there. So if I do my math, 10,000 divided by 0.815, I believe, then it'll take out, and that's a thumbnail thing, hopefully I didn't make a mistake, about $12,270 is what it'll decline the qualified account by, which would net out to the 10,000 that we calculated we needed. I just made that number up. I'm not saying on here you need a little bit more, like on the first year it wants 26,000. So it actually be taking out more than that. How much more? Just thumbnailing it, if I divide by the 0.815 again, 18.2, actually that's not exactly right, 18.815, 0.818 is what it is, sorry, my bad. If you divide by that, then you can come up with the number, 0.818, there we go. $32,034, and if I multiply that by 0.818, it comes out to the 26,204, which it shows in from growth in this year right here, not taking any from principal. So most likely we took that out. Okay, does that answer a lot of questions about taxes? I hope so. Do we have any other questions, please? Okay, let me do a poll real quick, just to wake everybody up. And here we go. how many meetings do you have on average with prospects before they become clients? Just curious, if you don't mind answering that. It's just information. And I'm going to share the results. It's kind of anonymous, but you might be interested in seeing what everybody on this call is doing. Okay. We got 80% voted. That means somebody's asleep. Okay. Okay, close that. Let me share it with you. Hopefully you can see that. For some reason, when you're the admin on GoToWebinar, it doesn't show you the poll results. It shows it off to the side, but I don't see the big pie chart screen that you see. So we don't have a huge number on the call today, probably because I didn't set it up a long time in advance, although they've proven and if you send these things out a week or two in advance, then not a lot of people show up. So we tend to start marketing them 2-3 days in advance. So we have most of the people doing 2 and 3 meetings, a couple of people doing 4 meetings, no one doing 1 meeting. That's interesting to me. Okay. Let's try this one. I haven't done this one in quite a while. And only answer this if you manage money, you do wealth management. If you only do annuities, then don't answer this question. It's more for wealth management. And the question is mainly, do you have an account minimum? Like, you're not going to take someone on as a client if they don't have at least $250,000 or $500,000. Those are the most typical that I've seen. But I've seen, a handful of high net worth advisors that don't take anyone less than $750,000 or $1 million. So if you do that, just answer the poll. Okay. I have a number of people answering other, and I'm not sure what that means. I'm guessing that it's lower than 250, or you take anyone on. If you answered other and you want to put it into the chat box that why you answered other, that'd be cool. I'm just trying to learn about what advisors are doing out there. I've talked to several thousand advisors, probably thousands of advisors over the years. So I have a lot of general impressions, but sometimes you do a poll and you get some surprising results. Okay, hopefully that was interesting. Oh, let me share the poll. Here's the poll. Okay, there you go. So a lot of people have lower minimums than, I don't see anybody with $500,000 minimum at all. Okay, let's see. Several people said theirs was less than 250. Okay, cool. Thank you for sharing that. Okay, another big question that comes up, and it comes up all the time, is how to model annuities, and I've done a number of webinars on that, but I'm going to just give you a very, very brief overview on that. And the number one that comes up is about modeling lifetime annuity income. So typically moving money from, say, qualified into annuity, or moving it, they've got a big pool of taxable investments. And I'm just going to, let's up the amount of money that these people have right now. Now they don't have any red, so I'm not doing this to show the solving of any problem. I'm just showing how to model annuities. So let's say they have $500,000 in qualified. I'm going to first go under special expense, and I'm going to take any line, I'm going to put annuity premium. And you might put the name of the annuity. You can word that however you want. So let's say they're going to put $250,000 into annuity. So he's putting half of his $500,000 into there. And let's say he's going to do it right now. He's age 61. and it's a one-time expense. So he's putting all $250 in there. And what's that going to do? I'm going to set a tax deferred only, and it'll pull it right out of the qualified account. And so step one is to suck the premiums out of the investments, and then we're going to model the income, because if you don't remove it from the investments, then it's going to continue to tap that money even though you've already moved it to the annuity to fund the income, and that would double count that money. So then we go to cash infusions, and again I go to any line. You can use number 5, annuity payments, but I can just go to number 1 and say lifetime annuity income. And I'm totally making this up, but what you would do is whatever product you're putting them into, you would have the insurance illustration that says, okay, if you put in $250,000 and you turn on the income at a certain age, let's say he's going to turn the income on at age 70, so he's not even going to turn on at 66 when he retires, turning on at 70, and then the insurance company says, oh, well, if you did that, we estimate that he's going to get $23,042 for life. I'm just making that up. And if we don't have any COLA rider, there's no growth on that. Now, you may have to pay taxes, and if you do, this would be the column. You're going to have to put in some tax rate if they owe taxes. If it's going to be their full tax rate, in this case we estimate it was 18.2. And when the money comes in, it's not going to ever go into tax deferred because it's already coming out of there, so I'll put taxable. And all that means is if the $23,000 comes into the picture and they don't need it in that year, the program's not just going to flush it down the toilet, it's going to accumulate it in the investment bucket. And in this case, the taxable investment bucket, it'll just be in their checking account, or they move it to a money market or something. So once they turn it on, they're getting this check. And they may break it down to monthly and whatnot, but as you know, our program does everything annually. So I'm going to add this into the plan. Actually, I didn't do that right. I forgot one factor. Duration in years. I'm going to do 40 or 50 to make it run to the end of the plan. And that way it repeats every year. Okay, so now you see the white other income. So there's your annuity income showing up as a cash infusion. And so basically they're going to get more guaranteed income without, being affected by the market. They're going to get that check every year or every month, however they end up taking it. Okay. Do you have any questions about that? Okay. One other question that came up. Let's see here. Okay. Janine is asking, do you have to then change the tax deferred from 500 to 250? No, not in this case, because we actually entered the 250 as a special expense, so it's already pulling it out. Now, if you want to get really quick and dirty and you don't enter a special expense, then yes, you would go in here and say, okay, Mr. Client, you got 500, but we're going to move 250 to annuity, so you're only going to have 250 left. And in this case, I had unchecked and removed the annuity premium. So that's an even quicker way to do it. I think you're better off putting the premium on a special expense, so at least if you do give someone a printout, then it would say special expense, funded, such and such an annuity, maybe you put the name in, or premium for, and you name the product. But so we did that via special expense. I'm going to put this back to 500. Okay, great. That was a good question. Anybody else have a question? All right. Don't know how many people on here sell long-term care insurance, but this comes up probably once a week, twice a week. Somebody asks about selling long-term care insurance. So I'll show you real quick. You're meeting with Sam and Sally. There's no red. Their picture's pretty good. And, hey, do you have any long-term care insurance? And they say no. Well, are you concerned about that? Well, they may say no, but they may be like, well, yeah, you know, my mother, my father, my in-laws, somebody went into a nursing home, so yeah, I'm pretty sure we're self-insured. So let's actually, before we do that, go to the savings graph. And yeah, we look out here at 76, they have a $1.1 million, 1.1, 1.2, 1.3. So they think, oh, it looks like we're going to be able to have over $1 million for most of our retirement. So no, we're not really worried about it. Okay, well, let's just put in an example anyway. I'm going to go here to line 2, and I'm going to put a long-term care. And as you know, the price varies all over the place, $50,000, $60,000, $70,000, $90,000, New York, California. I'm just going to put in, say, I don't know, $65,000 a year, and it's going up at maybe 5% a year in inflation, and we're going to say that something happens to one of them at age 75, and let's say it goes on for 4 years, and estimated inflation, I'm going to put 5, and we'll take the money anywhere we can get it, okay? So I'm going to add that into the plan. Let's see if that does anything. Okay, so here comes the long-term care expense, this huge spike. And it does make them run out of money around 92. So it's not overly dramatic. This is kind of on the edge whether this would really help a sale. But you know, like my grandmother was in the nursing home for 10 years. So I'm going to put 10. Let's see what that does. Okay, now you have a picture. It's totally depleted in year 7 that they had some kind of care. And of course, the different types of care, you know, I've had people in New York tell me it's more like 80, 90,000, so I'm going to put 85,000. But let's go back to 4 years, add that into the plan. And again, you got the big spike, they run out at 86. So again, you know, if they really wanted to leave money to their kids or, you know, do some kind of charitable foundation or give their money away, and then this is just eating it all up without the insurance. So that's basically how you model that. Now what you can do is say, okay, now that you're going to have insurance, so we're going to get rid of the event and we're going to pay the premiums. So first I'm going to get rid of the event. We'll go back to the original picture, and they don't have any problem. We go to but we showed them how we're going to really hurt their overall retirement savings. But the premiums, let's say they're expensive. I'm just making this up. Let's say it's $10,000 a year, but we're going to start it right now at age 61, and they're going to pay it. We estimated 75 was when they were having a long-term care event, so we're going to pay it for 14 years. And you see there we have increased expenses for the 14 years, but notice they don't want to run out of money out here. So, you know, you're basically paying for the insurance instead of the care, which devastated their investments. We go up here, and they still have almost $1 million, 972, 975, 954. So they're very close. So instead of losing it all, they bought the long-term care insurance. Hopefully that was helpful to you. Let's see, do we have any other questions? Why does Social Security decrease at age 100? Okay, Ernest, that's probably a good question, and I think I know the answer. Let's go back to our retirement picture, and we'll see. Okay, yeah, right here at age 100, you see it drop, and the pension drops. And I'm pretty sure because we have an age difference here. Yeah, so Sally's 1 year younger than Sam, but we didn't adjust our Social Security numbers. So Sam is stopping at 100, and Sally, we have it stopping at 100, and so it's kind of like a fence post problem. We're off by 1 year. So I'm going to Sam, and if he lived to be 101, then he would still get his Social Security. So all I got to do is push that out, and that would be more what you would expect. So sometimes you got to be careful about these start and stop ages for the pensions and Social Security, especially if you run it out to 100 and the spouse is younger. That's a typical situation. You also have on other assumptions the end illustration at age, and we're ending it at 100, and that would be when if in the case of a couples plan, when the youngest spouse turns 100. So that's why we kept going past when Sam was 100, he's 101, but the spouse is finally reaching 100. So if the spouse was 5 or 10 years younger, we'd be running Sam out to 105 and 110. Hopefully he's got really good health genes. One thing you can do with end illustration at age, I don't know if anybody's ever tried this, but you can say, oh, you know, they're not going to live past 90. It's not a huge benefit, but it helps focus your clients in. The width of the bars is wider and fewer bars, and it's almost like a zoom in function in a lot of ways, so you're ignoring the after 90 period. So you can use that to kind of zoom in and out of the illustration. So got more there. I'm going to go back to 100. There we go. All right. Do we have any other questions? All right. I have nothing else that anyone asked me to cover. So if there aren't any questions coming in, then probably going to end the call. So going once, going twice. All right, anybody have any questions? Let's see. Okay, somebody's just under the wire here. All right, Ernest, talk about Social Security options. Okay, we can do that. So option 1, you have some idea what their Social Security benefit is. They got their statement in hand. They've given you the statement, or maybe somehow they've told you how much they're going to get, which is rare. So I just go in here, I click on the benefit, and they told me they're going to get $23,456 a year, and they're going to start that maybe at age 66. So I just put that in, voila. Now that's called manually entering an estimate or hand entering an estimate, and when you do that, you still can go under settings, Social Security, and set the cost of living adjustment. So that's in section 2 here where it says enter your own estimated benefit. So here is where you set the COLA if you're entering the benefit by hand. The 20-year average, we have a little spreadsheet. The 20-year average is 2.26. So I'm going to go set it to 2.3 and hit OK. All right, so now we've set their Social Security to 2.3%, and there we go. All right, so the next option is to enable the built-in estimate. So the built-in estimate uses the Social Security Administration's algorithm. If you go to their website, there's a quick calc on there that is pretty close to ours. Just going back in history, we were approached by a firm that wanted us to add the benefit estimate to the software back in the late 90s, and they put us in touch with their actuarial firm that had a piece of software that did the estimate. Just it may have been the NEPIA DOS program. I don't know which program it was, but we worked on the estimate through the actuarial firm until it matched, and we put that into the software. And we also, around the same time, created a web-based tool to do the estimator. So we're talking about, like, I don't know the exact year, it might have been 97, 98. Well, the actual Social Security Administration didn't come out with a web-based tool till, I think, 2003 or 4. It may have been 2005. It was a good 9, 10 years after we had done it. So to enable the estimate in here, you go to Settings, Social Security, and all you do is click this box. That's it. Click the checkbox to use the built-in estimate. Now, all that being said, the algorithm requires that you have the person's actual earnings history. So the SSA knows all the earnings that you've reported or that your clients reported, and that's how they feed that into the calculation. Well, we don't have that. All we have is their annual job income today, how old they are today, when they're going to retire, and a raise factor. So we build a simulated 35 years earnings history, and we do that with a factor going back in time. So in this case, Sam is 61. We got to figure out what he made, back to when he was like 22 years old, and then we use the raise factor to go from 61 to 66, and then we feed that in the algorithm. Now, because of that, because we have to make assumptions there, we've seen the estimate does tend to be on the high side, because like when you're 22, the amount of money you made in reality is probably not very much, 23, 24, whereas our software just uses a factor to go into the past, and it's kind of linear, whereas a lot of times people start very low on the pole, and then as they go on, they get more incremental jumps. So it's not quite the same. So in that case, if you think it's too high, and you don't want to mislead your clients, so you can scale it back a little bit. That's what this little scale factor is. So if I click OK, you'll see that it comes up with an estimate. And in this case, 23,122. Notice I can't click on that and edit it because it's fed from the estimate. I think that's funny that I'd estimated 23,345 and the actual estimate came up 23,122. I don't know if I've just been doing this a long time or I just got lucky. But there's your Social Security options. Of course, if you have a spouse, it's going to estimate them as well and combine the two. Any other questions? Okay, well, I hope you found this useful. We tend to have not had a huge number of questions when we do these things, so I've kind of backed off the number of live calls that I'm doing. When we did it weekly, I would literally log on there and nobody had any questions, and then I also wondered why people logged on. So just kind of back this off a little bit to more like once a month. Of course, you're always free to email us and send in a ticket. But if you want to reach me live, these calls are going to be probably one of the better ways to do that, and I can illustrate things. So keep that in mind when I email out that we're going to have a live call. Jump on there and take advantage of the opportunity. Hey, I appreciate everyone using the RetirementView software. Tell your colleagues, tell your FMOs, tell your broker-dealers, your RIAs, your friends, your relatives. If you have any clients that are engineers and accountants and they're driving you crazy, you may want to get point them to the consumer versions and let them have at it at home on their own. That's not going to eliminate you as their advisor. It's just going to help you work with them and satisfy all their curiosity without, spending 2 or 3 hours on there. So I appreciate you being on here. Wishing you a lot of success this year in your practice, and thanks as always, and happy planning, and we'll be in touch. See you. Have a great summer. Bye.